Okay, good morning. Welcome to today's webinar, One Big Beautiful Bill, Opportunities for the Cannabis Industry. Today's webinar will be highly informative. We aim to answer your questions about the OBBB, and we want you to know the cannabis specialists at HBK are available to you beyond today's one-hour webinar. We'll have time today for some Q&A, but this is a big event, so if we don't answer your questions today, please get in touch with us. Our presenter's contact information is in the bio section of your screen. To submit your questions, use the Q&A box that's located in the lower left corner of your screen. Today's event will be recorded, and we'll post the recording on HBK's YouTube channel, and a copy of the recording will be emailed to you. Please take a moment to follow our LinkedIn page by clicking on the link below. There will be more updates and more webinars about the One Big Beautiful Bill in the coming weeks and months, and we don't want you to miss a single one. Our presenters for today are two cannabis solution specialists, National Director Chris Marrie and Senior Manager Jesse Hubers. And now I will turn things over to Chris and Jesse to get us started.
Thank you very much, Wayne. Good morning, everyone. Thank you for making the time to be here. My name is Chris Marrie. I'm the National Director of HBK Cannabis Solutions. Today, I'm going to be presenting with Jesse Hubers, who is our cannabis industry tax leader for the Cannabis Solutions Group, as well as a member of our National Tax Advisory Group. He spent a lot of time working in the cannabis industry with me and our team, and is very well versed in the unique challenges that we all face. Today, we're going to be talking about the One Big Beautiful Bill. There's certainly been a lot to unpack here. I think when we kind of look at this holistically, there's certainly some incentives and opportunities that are in this bill that are really good for manufacturing, we'll call it, which in theory is good for the cannabis industry. Unfortunately, as most of us are aware, there are some challenges navigating some of these opportunities because we face the specter of 280E, which other businesses currently just don't have to deal with. Today, we're going to really focus on three areas where we think that there's some opportunity for the cannabis industry to take advantage of the provisions in the One Big Beautiful Bill. Really, those are going to be some accelerated depreciation and bonus depreciation opportunities that we see. There's also some new opportunities related to real property that's considered production property. That's kind of a new asset class, if you will, that's been created by the One Big Beautiful Bill. After that, we're going to talk a little bit about some employee tax breaks and incentives that are available. And then there's also some new structuring opportunities with qualified small business stock and qualified opportunity zones that we may be able to implement proactively and then potentially save some tax down the road with some of the structuring in the event that there's an exit or a sale of the property. Right now, I'll turn it over to Jesse to kind of get started on the presentation. And as Wayne said, any questions that you have, please post them. We'd be happy to field those and answer anything that we can. Thank you.
Thanks, Chris, and thanks everybody for joining. Got a lot to talk about here. One thing in particular we've been waiting on for a really long time. So bonus depreciation is finally back. We've been thinking this was going to come back for a while, but it seemed like it was about to fully phase out. So it's back permanently, not just for another extended period of time. So originally we had, from the TCJA's inception through 22, we had a period there where we had 100% bonus depreciation. Section 179 became kind of irrelevant for a little while. But in the last 2 years, it started to phase down. We had an 80% year and a 60% year. It's scheduled to go down to 40, 20, and then phase out completely. So what the new bill does is it takes it back up in 2025, back up to 100%, and then it just stays there forever. So the 80% year and the 60% year, it's not as if it retroactively goes back. We're not going to have the opportunity to amend returns or anything like that. But it's going to go back up to 100% this year. If you put something into service last year, it's kind of tough luck. You got 60%. But going into the future, this is going to be a pretty strong opportunity. So just an overview on bonus depreciation. It's a full write-off for a property with recovery periods of 20 years or less, but it has to be acquired by purchase from an unrelated party. So this has to be the first time that you've used the property. You can't have used it before, in another entity or something like that, or, bought it from a related person, whether it's a related entity, like a brother sister corporation, or even just somebody related by a family member or something like that. Some common property that we see that would qualify would be something like greenhouse structures, which are 10-year ag property, grow equipment like lighting, which would be 5-year property, processing like edible manufacturing equipment, stuff like that. Or if you had bought a big piece of real property and had a cost segregation study performed, they would identify 5, 7, 10, and 15-year property that would qualify as well. So a lot of property that facially qualifies for bonus depreciation, but obviously we've got the 280E component, which is problematic. So if you have a cannabis operator who buys something like grow equipment, right? So the first question is, okay, well, we've got depreciation, that's a deduction, it's disallowed anyways, who cares? Well, as most of you probably already know, well, if it's a depreciation that you can take through cost of goods sold because it's production equipment, well, then we still get to deduct it. However, we've got this Treasury regulation here that says, okay, you may be able to take depreciation through cost of goods sold, but you're limited by depreciation taken in your financial reports, and further, only to the extent that those are consistent with generally accepted accounting principles. So you can't just say, okay, well, I'm going to put bonus depreciation in my financials, and then, we'll just take bonus on the tax return. So if you're using the regular, inventory rules, you're limited by GAAP. So the way that it would work is if you bought a $100,000 piece of equipment, you may qualify for 100% bonus depreciation, but you're only going to be able to take GAAP depreciation through cost of goods sold, which may be 20, if it's $100,000, it may be 20,000 or something like that in year one. And then the 80,000 of additional depreciation you get goes into ordinary business deductions, which are of course disallowed. So in an operating business, we have to figure out a way to get around that. Oftentimes that's through putting it in a kind of brother sister corporation, kind of differentiating the ownership a little bit to make sure that we don't run afoul of some problematic cases, and then depreciate it in a non-cannabis entity off to the side. Or maybe we pursue something like an opinion letter, and just don't apply 280E going forward. Obviously, there's a lot of tax risk associated with that, and it doesn't work for everybody. Is that something that you'd like to talk about? We're happy to, talk to people about that on a case-by-case basis. That's something that's getting to be a lot more popular in recent years. It's unclear how the IRS is going to, deal with this. It's growing amount of operators who are pursuing those. So it could turn out well, or it could turn out as a disaster. So that remains to be seen. We do have another type of property that's going to qualify for bonus depreciation. So like I said before, normally it's property with a recovery period of 20 years or less. This is the first time, to my knowledge, that we have 39-year property that could qualify for bonus depreciation. So this, aside from the normal 280E cannabis challenges, if you set that to the side, this is a extremely powerful depreciation provision. So we've got a new class of property called qualified production property, which is generally non-residential real property, normally 39-year property, which is used in manufacturing or agriculture, where construction begins within this time period that they provided us, and is placed in service by the end of 2030. So, if you were to build a $30 million cultivation facility or processing facility, what this is saying is that you can treat that as depreciable property, and the full cost of the building you could write off in year one. which sounds insane even to say. But that's what we've got here. We do have some caveats, which make it challenging for cannabis businesses to use this. So typically what we would do, I kind of alluded to this before, if we want to make use of bonus depreciation, well, it can't be within the cannabis entity, right? So we might have to say, okay, well, we're going to form a real estate company. We're going to put this depreciable property in there. We're going to do a cost segregation study to get as much bonus eligible property as possible. And then we're going to depreciate that alongside the cannabis business. And then we'll kind of net the loss against the gain, so to speak. So the QPP special type of property specifically excludes lessors. So we're not able to, outside of the cannabis business, I can't build a manufacturing facility for Ford, lease it to Ford, and then expect to be able to get this 100% bonus depreciation on it. It only works if Ford builds the facility, to manufacture its cars or whatever, then it's going to be able to take that 100% bonus. So in the context of a cannabis business, I can't build a cultivation facility and then lease it to my own cannabis business and think I'm going to get this depreciation. The only way that it works is if I put this inside of the cannabis business, which, as we said before, well, if it's inside the cannabis business, well, then we can't take the bonus depreciation. So I think the only way that this works for a licensed operator is if we have an opinion letter and we're just going to ignore 280E. Aside from that, it may also work for contract manufacturers. So if you've got somebody who's not licensed, right, maybe you're making chocolate bars or gummies or something for folks that do have a license and you're just licensed to contract manufacture for them, it may work for you if you have your own facility on your own books. So I think we've got some narrow opportunities where this may work, but I don't know that this is going to be a widespread popular item for cannabis businesses.
And Jesse, doesn't this kind of, even outside of the cannabis industry, doesn't this kind of fly in the face of a lot of the conventional wisdom around how you would structure real estate in an operating business?
Yeah, it does. And it's unclear what they were getting at when they put this, leasing prohibition, because I would imagine that most companies outside of, big public companies would be leasing their property to themselves, because aside from any tax benefits that you would get, like, in the case of a cannabis business where you would separate it and be able to, benefit from depreciation when you otherwise wouldn't, there's a lot of, liability reasons where you would do that. So even, aside from your tax advisors, your lawyers may be telling you, well, this needs to be in a separate entity so that, if you have some sort of failure at the business, at least they can't go against your real estate. We can't really advise too much on liability protection issues, but that's something that you might have to give up if you want this tax benefit, because it's got to be inside of the same entity. I will caveat that with, it's got to be inside the same tax entity. So you may be able to use a disregarded entity or something to get some of those liability protections. Your attorneys can talk with you about that. But at least for tax purposes, it has to be in the same tax recognized entity.
And that was just kind of my thought. I mean, the self-rental prohibition seems to undermine any intent to incentivize the operating business. I understand that they don't want third-party lessors to just take advantage. I think the goal was to incentivize the operating business, but this kind of goes against, to me, everything that, the legal community and probably the accounting community has been advising for a long time.
Yeah, no, for sure. Yeah, and maybe that's what they were getting at. They didn't want just the real estate lobby to, which is surprising because they're like the most powerful lobby in the world, it seems like. But in any event, yeah, it seems like they, just didn't want real estate investors to be able to get the benefit of this. It was more geared towards manufacturers. So I don't know, maybe they'll make an exception or carve out. Sometimes they do technical corrections, but as far as what we've got now, this is what we're stuck with. The next thing we've got is, yeah, for sure. So the bill amends Section 174 to allow full expensing of domestic R&D costs. So previously they were amortizable over 5 years and capitalizable in year one. Foreign R&D was capitalizable and amortizable over 15 years. That's staying, right? So foreign R&D, if you got that going on, is still capitalizable. You still got to amortize it over 15 years. But if you're doing domestic R&D, you just write it off as incurred. So that was the norm up until we had this delayed implementation of Section 174. So that was the norm. And then we've got, I think it was 2022, where all of a sudden we had to start capitalizing these R&D costs. And it really kind of put a hindrance on the R&D credit, right? Because, like, let's say you've got $100 of R&D costs. You might not have separately identified those as R&D costs. And normally, you would have just expensed them as ordinary business deductions under Section 162, right? But with 174, if you've separately identified them, well, then now they're capitalizable. They may have been capitalizable already, but you didn't know it. But if you do an R&D study because you want to get an R&D credit, well, now you know their R&D cost, right? Because you've already separately identified them as QREs for purposes of the credit. So now you got to capitalize it. So if you've got $100 of costs, then you may get let's call it a $10 R&D credit, but you're having to capitalize $100 of costs that otherwise would have been deductible at, let's call it a 25% marginal rate. So your tax benefit of the $10 credit is now offset by the $25 in tax costs in year one. So even though all over the time horizon of the amortization period, you're still at a benefit for getting the R&D credit, in year one, you're cash flow negative. And beyond that, you still have to pay the folks that did the R&D study, right? So a lot of people really lost interest in the R&D credit with, Section 174 coming into play. But now that this is going away, I think R&D credits are going to become a lot more, powerful and interesting. So if you've previously capitalized Section 174 costs, over 22, 23, 24, we've got a new transition rule that you can deduct all unamortized domestic R&D either in 2025 or ratably over 25 and 26. And then further than that, if you're a small business, you can actually go back and amend those returns and claim refunds for those capitalized amounts. So that's going to be a good opportunity for the coming years, in addition to the R&D credits, being able to recover those costs faster. And then so on the R&D credit, we got the obvious question, well, aren't all credits disallowed under 280E? Yes and no. So we've got a lot of states that have decoupled from 280E, notably California, which also offers a pretty powerful R&D credit. Historically, we've still had this issue, well, am I going to separately identify all these costs and then have to capitalize them just to get this kind of smaller state credit? Well, now that might be a lot more attractive, right? If we're not going to have to capitalize on those costs. So we still got state credits that will qualify. And again, just getting back to this, this issue of, well, what if we get in the tax opinion letter and we just ignore 280E? Well, that opens up a lot of opportunities, one of which being the R&D credit, because cannabis businesses, this is still a pretty new industry, and you are often doing a lot of R&D without realizing it. So R&D isn't necessarily what you think of as being R&D. You don't have to have a group of guys sitting in a room, like cooking up new strains of cannabis or something to be R&D. You don't have to have an R&D department, right? So it's creating not something that's new or novel to the industry even, but something that's new to you, right? So you're doing something to improve your processes, at your company, right? You're doing research and development to develop your own processes, procedures, products. So there's a lot of costs that you don't realize are R&D, that may be sitting there and qualify if you're not following 280E. So that's something, to think about and talk about. If you've not heard about, what's going on with these opinion letters and it's something that you'd like to talk about, we can certainly, have that conversation with you. Our firm doesn't prepare the letters, but we work with many attorneys that do, and obviously prepare the tax returns and the related disclosure schedules. Let's see.
See, with this also, I mean, I would think maybe provide a pretty big opportunity for maybe some ancillary businesses, like, for example, maybe testing labs that are working on new and innovative ways to perform the testing and things like that. Is this something that maybe really would be a win for them?
Yeah, I think so. We even had a client that was developing like a tech platform to have like virtual dispensaries that you could walk in and look at their products, and was developing software. And we were looking at the R&D credit for them. Excuse me, coming off a cold. But in any event, yeah, that's a great point. There's a lot of ancillary business who are not licensed operators. Maybe you're a co-pack, co-manufacturer kind of situation, and do qualify for the credit for your own manufacturing processes that you're doing on behalf of a licensed operator. A lot of opportunities that might be outside of licensed cannabis production. Okay, so that's kind of everything we had as far as acceleration of cost recovery. We've also got some employee tax breaks. These are kind of those big campaign promises, right? That seemed kind of cutesy when they were being talked about, but sure enough, they did deliver on them. They came through a little bit different than we were expecting. So we were, I got a meme up here. So a lot of people are thinking people are just going to tip less because the tips aren't taxable. So we'll see if that comes to fruition. That would be pretty disappointing if that happened. But in any event, so these were originally, I think, envisioned by most people as an exclusion, right? So we're getting tips. We're just not going to report that on our W-2 anymore. We're not going to pay taxes on it. It's going to be great. What it actually came out as a deduction. So you do get to take this deduction regardless of whether or not you itemize, but it is a deduction, and it's only a deduction for federal income tax purposes. So you're still going to have to pay FICA withholding on the tips, which is sometimes more than even the federal income taxes, right? It's 7.65% for employee and employer. And for folks who have historically not reported their tips, in industries where you get a lot of cash tips, this may even make you worse off, right? Because if you're going to all of a sudden start reporting your tips, right, so you can qualify for the deduction, well, now you're going to be paying FICA, which you never paid. So you may be worse off than you were before. Obviously, we always recommend complying with the tax code, right? So you should always report your tips and all that good stuff. But it's not really as big of a benefit as I think people thought. So it's got to be reported on W-2. It's got to be for an occupation that traditionally and customarily receive tips, right? So you can't all of a sudden, tip your car salesman $75,000 for that $1 SUV you bought, right? So we got to have, a history of tipping, whatever the job is. I don't know what they're going to do if we start seeing $74 tips for a $1 haircut. There obviously has been a tipped industry, but we might see the amount of tip change. But in any event, this is kind of a short-term play. It's only effective from 25 to 28, and it is subject to a high income phase out. So, if you're working at some fancy wine restaurant and getting gigantic tips, you might not benefit from this in the same way that other folks would. Let's see. How do I make this go? Okay, no tax on overtime. So this one's a little bit different. The other one was written as just a straight $25,000 cap. This one is a $12,500 cap, or $25,000 if you're married filing jointly. So it's for qualified overtime compensation. We got the same time horizon, right? It's only good through 28, and it's subject to high income phase out, right? So If you're a highly compensated person, you might not benefit from overtime pay. But if you're below that threshold, it may be kind of a small benefit. Tracking is going to be important for both of these. So if your employer is not tracking, or if you are the employer and you're not tracking overtime, appropriately, you may not have the information to be able to tell your employees how much overtime pay they had, right? So it's going to be really important to be able to have the records in place to be able to say, this was your overtime pay for the year, and report that to them separately at the end of the year so that they can claim that deduction. Tips is a little bit more straightforward, a little bit easier to report. Overtime is generally easy if you are getting paid time and a half anyways. Normally you got that stuff separate, but something to think about for sure. So for cannabis businesses, there's some obvious questions. Well, if these are structured as deductions and not exclusions as we originally thought, are the deductions going to be disallowed, right? I think it's questionable, right? So we had the same kind of question come up with, Section 199A. And so 280E says, we're going to disallow deductions and credits for amounts paid or incurred in the trafficking of cannabis, right? So if we think about the QBI 199A deduction, I think most of the industry came to the conclusion that, well, this deduction is just written as 20% off the top, right? It's not like we're getting a deduction that's in any way correlated to some amount paid or incurred in trafficking cannabis, right? It's not like we paid $20,000 for something, so we get a $20,000 deduction. We have net income of $100,000, so 20% of that is a $20,000 deduction. So I think facially 280E doesn't apply to that deduction, and so the industry has not been applying 280E there. And I think the same could be said about these, right? So these deductions are just like a flat amount that comes off the top of wages, right? There's not $25,000 that you as an employee paid or incurred to traffic cannabis. So I don't think that 280E is going to apply to disallow these deductions. And even if it did, I doubt this would be a priority for the IRS. So I would, if I was an employee of a cannabis business, I would certainly claim these deductions and just kind of see what happens.
Jesse,
like I said,
go
ahead.
I was just going to ask, as a non-tax person, just so make sure I understand. So basically these deductions now are taken on the 1040, right? So it's not necessarily the cannabis business that's involved in taking the deduction. However, it still is wages paid by the cannabis business directly to the person. So is that kind of where the gray area would come in?
Right, like looking at 280E from the employee's perspective. So the IRS has long said that even if you're an employee, you're engaged in the trade or business of being an employee. And that was important for purposes of certain employee deductions that used to be allowable that have since gone away. So you are engaged in a trade or business of being an employee, which consists of trafficking cannabis, right? Because you're sitting behind a cash register in a lot of cases selling weed, right? So I think, facially that part of the statute would apply to you as an employee. So I think the way that we get out of it is because it's not for an amount paid or incurred in that trade or business that you are engaged in. So I think these are going to be good for, whether it's tipped bud tenders or, people in the plant working overtime. I think both of them should qualify for this. Another big one, kind of getting off of the employee incentives, is qualified small business stock. So this is something we've been advocating for quite some time, even before the change. So qualified small business stock got a lot more attractive with the Big Beautiful Bill. The maximum exclusion was increased from 10 million to 15 million. And the gross asset threshold that's required to qualify that you be under was increased from 50 million to 75 million. And so I'll get into all of these qualification kind of things in, I think, one of the next slides. But we also got, in addition to the increased cap, we've got a new tiered kind of entry into the percentage exclusion. So the way that this is set up is qualified small business stock. It used to be if you held on to qualified small business stock for 5 years, you qualified for 100% exclusion of the gain, subject to a cap of either $10 million or 10x your adjusted basis in the stock. And now what we've got is, instead of just a kind of cliff where all of a sudden you're at that 5 years, now you get to exclude 100%. We've got this tiered system where once you hit 3 years, you're qualified to exclude 50%. At 4 years, you can exclude 75%. And at 5 years, you still get to exclude that 100%. And it's all subject to the same cap, which was increased from 10 to 15. So, whether you've got $40 million gain and you get to exclude 50% of it because you only held it for 3 years, it's not 20 million, it's going to be still that $15 million cap. Or, by that point, it wouldn't matter if you held it for 3 or 5 years, because you're going to be at that $15 million cap anyway. So it doesn't matter if it's 50% or 100%. So we got kind of two different caps to think about here. The requirements to qualify. So you've got to have original issuance of C corporation stock. So if you've got an S corporation, it's almost impossible to get qualified small business stock. You can get into it, but not without restarting your holding period and having a significant amount of gain that's not going to qualify. Because if you create a new C corporation, which is kind of what you have to eventually do to get into qualified small business stock, everything that you contribute, the pre-contribution gain, does not qualify for exclusion. So if you've got, let's just say in an easier situation, you've been operating as a partnership, and you say, oh, I want to make use of this qualified, I think I might sell within 3 to 5 years. I'm going to make an election to treat it as a corporation. Well, so what happens is you have this deemed incorporation whereby you contribute all of the assets of the partnership into a new C corporation, including your goodwill, right? So all of these assets get stepped up to fair market value for purposes of determining, the excludable gain. And so if your business is worth $40 million, and then you ultimately sell it for $60 million, and you got 6 partners, they all have $10 million in gain, it's not as if they're all going to get to exclude $10 million, because 40 million of that is not going to be excludable, because that was before you were a C corporation. Only the $20 million is excludable. So the 6 people will collectively potentially get to exclude that $20 million growth since you've been a C corporation. So we're going to have original issuance of C corporation stock. So whether you form a new company as a C corporation, you form an LLC and elect for it to be treated as a C corporation, or you've been operating as a partnership and then decide to convert to a C corporation. All those are ways you can get into, qualified small business stock. If you're an S corporation, we could look at something like doing an F reorganization to try to get you into, qualified small business stock. It's going to be a lot more difficult and cumbersome, but it is possible. You also have to be a qualified small business when the stock is issued. So if you exceed some of these thresholds before you convert, it's not going to work. So aggregate gross assets can't exceed $75 million. It's not as simple as just looking at your balance sheet and saying, oh, I'm less than 75 million, I can be qualified small business, because you also have to look at goodwill, which would not be on your balance sheet yet if you did not acquire that goodwill. So if you have a business, you could sell it today for $200 million, but you've got $40 million of assets in your books, you're not going to be able to be qualified small business stock, because you've got $160 million in goodwill inside your business that's just not reported. So normally, if you're going to do this, you would get a valuation to try to support your value, just because, there's a lot of money on the table. Odds are the IRS is going to look at this as a fruitful thing to challenge, especially if you haven't done your due diligence beforehand. So if you're wanting to look into getting into qualified small business stock, a lot of things to consider. Certainly talk to your tax advisor. If you don't have one, talk to us. We'd be happy to talk to you about it. Excuse me. So, we've got that $75 million gross asset threshold. We've also got a requirement that 80% of your assets are used in the active conduct of a qualified trade or business. So if you have a lot of investments in your corporation, that may be troublesome. If you have a cultivation inside of the same entity, that could be a problem if it's more than 20% of the assets are used in that cultivation. Because this is like the only time in the code that I'm aware of where they discriminate against farmers. So I don't know who the farmers pissed off when they were writing this code section, but a qualified small business is like anybody but bankers and farmers. So, if you are a cultivator, I think generally we look at that as being engaged in the trade or business of farming. Some people make the argument that it's more akin to like a pharmaceutical operation. I would say I doubt it. I think once you get into processing, then maybe you're more in a pharmaceutical operation. But in any case, I think the farming is going to be problematic. So if you're going to get into qualified small business stock, sometimes it's going to make sense to try to separate these into, if you're a vertically operated or integrated operator, maybe you want to separate your processing from your cultivation from your retail, right? And then maybe you pursue qualified small business stock for retail and processing, and then leave cultivation to pass. A lot of different ways you could do this. And the other benefit of that is there's no brother-sister aggregation for qualified small business stock. So if you've got retail as a C corporation and processing as a C corporation, you might be able to get 2 bites at the apple for qualified small business stock. Maybe instead of selling the whole thing for 200 million, you sell all 3 pieces for 67 million each, and then you get to exclude a separate QSB amount for each of the 67 million sales. So a lot of opportunities there, a lot to think about. Obviously, people would have kind of trepidation. Well, I'm a cannabis business. Do I even qualify for this? So the good part about this is written as an exclusion. And so deductions and exclusions, most of the time, that's a meaningless distinction in tax. But for cannabis, it's really important because 280E disallows deductions and credits. It does not disallow exclusions. So if something's written as an exclusion, 280E does not apply, right? So the exclusion of gain under qualified small business stock is just as valuable for a cannabis business as anybody else.
Jesse,
like I said, cultivation. Oh, go ahead.
I was just going to ask with the cultivation piece, if you originally formed the business where they're all together, and then later on you decide you want to go down this road and create a new C Corp, can you then remove the processing and manufacturing from the cultivation, or is it tainted at that point?
So if you're forming a new business, as long as it's not a tax-free transaction, so when you have like a tax-free transaction, a lot of times it'll carry all the history of the trade or business with it, right? So you might have a problem where you're looking at, okay, over this trade or business's life, have 80% of the assets been used in, qualified trade or businesses. And so then we'd have to look at this cannabis cultivation piece. So, something we'd have to think about, but there's certainly ways that you can structure it. And we have, structured with our clients' attorneys to make this work. But yeah, it's certainly something you'd want to look out for.
Thank you.
So in many cases, we kind of have this idea of, well, I got to be a C corporation and then I'm double taxed, right? So that's kind of a little bit more of I wouldn't say a myth, but something that was a lot more true when we had a 35% corporate tax rate. With the 20% rate that we've got now, we're a lot closer to pass-through income tax rate even with the double tax, especially if you don't qualify for the QBI deduction, which many retailers don't qualify for. So in some cases, being a C corporation, even if you don't qualify for qualified small business stock, can improve your cash flow. So I put together a little kind of chart here. So I've got a pass-through entity with QBI, pass-through entity without QBI, a passive pass-through entity without QBI, and then corporate, right? And so the reason that I put here without QBI, because the question I think most people would have, well, why would it be without QBI? Why wouldn't we, of course we're going to qualify for QBI. The problem is that QBI's limitations with respect to W-2 wages only count W-2 wages if those wages are deductible, right? So if you're a cultivator or a processor, most of your wages probably are going to be deductible because they're going through cost of goods sold. So you probably will get the QBI deduction. But if you're a retailer, all those wages are indirect cost at most, which aren't capitalizable into inventory, or they are, SG&A, certainly not capitalizable in inventory. So none of those are going to be deductible, so they don't qualify towards the W-2 limitation. So you get phased out of the QBI deduction really quick in a retail entity. So you're looking at that top rate of 37% rather than that 80% of 37%, which is about 30%. And beyond that, if you're a passive investor, well, then you also get this 3.8% net investment income tax on top of it. So you're looking at almost 41%. So, if we start from the same $100, we just look at the corporation first. They're going to pay $21 in corporate tax and have $79 left over. If we assume they distribute that $79 right away, they're going to pay additional 23.8% tax on that. It's going to be about $19, and they'll have $60 left over. So if you're a passive entity with QBI deduction, you're going to pay 80% of, the top marginal rate, about $30 in tax one time. You've got $70 left over. So you're still better off than the corporation. If you lose that QBI deduction, now all of a sudden you're pretty close to where the corporation's at, right? You're at $63. And if you also are a passive investor, you might as well have been a corporation, right? Because you're going to pay less tax. And then the other benefit of this is you only pay this $19 if you distribute a dividend. If you're like any cannabis business that I know, every dollar that you make is being reinvested into the corporation, or beyond that, paying insane taxes because of 280E, right? So this $19 in many cases is just a fugazi, right? Like, it's never going to see this money. Like, that's never going to get paid. And if you qualify for qualified small business stock, you're certainly never going to pay this, because you're just going to reinvest everything, and then you're going to sell the company and then exclude the gain, right? Because you got to do a stock sale if you want to get qualified small business stock exclusion. So in some cases, the math isn't $60 compared to these, it's $79 compared to all of these. And you'll notice that $79 is better than any of these numbers. So C corporations, even if we're not talking about qualified small business stock, and you are going to have to pay this $19, you may be better off than this. But this $19, you might not pay that for years and years and years, right? So there's a time value component that's kind of hard to quantify here, because we don't know how long it's going to be until you pay that $19. So C corporations, I think, make a lot more sense today, especially with cannabis businesses, because this $20 to $21 we're assuming here, could be a lot more for a cannabis business if you're paying 21%. So you may never hit this $19. And additionally, these percentages may be a lot higher, considering 280E as well. Other thing we got is qualified opportunity zones. We've had these for quite some time, but they're now extended permanently. So they did have a time horizon that was coming up against us pretty quick. Now we're going to have a rolling kind of qualified opportunity zone program where Your deferred gain, you just pick it up after 5 years instead of some set date by statute. So the way QOZ opportunities work is you have to have a capital gain, right? So you sold some property at a gain, and then you reinvest that gain into property in a qualified opportunity zone. And then you get to defer that gain for 5 years, and then you get a 10% basis step up, and then you pick up that gain. But that's the small benefit. The big benefit is all of the money that you reinvested into the qualified opportunity zone. If you hold that for 10 years, it gets a full basis step up to fair market value. So no matter what you sell it for, you don't pay any taxes. So it's not like the qualified small business stock where we had a cap, right, of $15 million. This is no matter what you sell it for. You could sell it for $1 trillion, become the richest man on the face of the earth, and you would not pay any taxes on it. So, I mean, that would be hard to do in a qualified opportunity zone because it's, by its nature, economically depressed areas. But if you are in the cannabis industry, and what we see in the cannabis industry is a lot of times these licenses get pushed into economically depressed areas. You might have gotten a license in a qualified opportunity zone, and that's your only option, right? So if you're there, it would really be worthwhile to go ahead and make use of this opportunity to get your business set up as a qualifying opportunity fund to be able to make use of this exclusion. So you'll have to identify a gain, maybe you'll have to trigger a gain and reinvest that into the zone. And it may be also a good opportunity to raise capital, right? Because a lot of people would be interested in getting involved in a qualified opportunity zone, but not have a business venture in mind or some sort of opportunity to get involved in. If you've got a license in an opportunity zone, that's where you're going to have to be anyways. It would be a good thing to identify that opportunity and really be able to capitalize on it. Because for some folks who are paying a lot of taxes, a totally tax-free gain in an industry that is historically had a lot of growth opportunity would be a really attractive investment. A new rule that we did get would freeze this step up after 30 years. So, if your business kept growing in value over the next 30 years and then you sold it in year 31, and you sold it for $1.1 trillion, and it was worth $1 trillion after 30 years, the 0.1 you're still going to have to pay tax on. So this kind of mitigates it a little bit. So you can't do this forever, but it's certainly still a pretty powerful tax exclusion. And again, this is set up as an exclusion, not a deduction. So 280E doesn't apply. There is an exclusion for certain sin businesses, but apparently Congress doesn't think that cannabis is sinful enough. So you can't do this if you're, running what was it? I think alcohol was excluded and like certain, kind of other risque kind of industries, but cannabis was noticeably missing from that list. So cannabis operators can certainly qualify for this. The last thing we got here, I think we got a few more minutes to talk about it, is gain deferral on sales of farmland. So I don't know, this is going to be kind of a throwaway. Like, I'm not sure that this is even going to work. So you can, if you sell qualified farmland to a qualified farmer, and that farmland has been used in farming for 10 years and is subject to a restriction that you presumably have to put on it to be used for farming for 10 more years, then you can take your gain and you can pay it over 4 years. So in certain narrow situations, I think this could potentially work for cannabis cultivators. There's nothing in the statute that excludes an indoor grow. And so, I don't think this is what they had envisioned when they wrote this, right? Of course, they're thinking of like a family farm growing corn or something in the Midwest. But there's nothing in the statute that says it's got to be, vast farmland growing, traditional crops. If you've got an indoor grow, it's real estate, it's used for farming, and you're going to sell it to another grower that's also going to use it for cultivation. I think facially you could still apply for, qualify for this. I think it remains to be seen kind of how Treasury is going to interpret this. When I looked at the bill, I think I recall there was a lot of items where they asked Treasury to expand. So, we might get some regulations which kind of narrow its application. So I think we're going to have to watch this one and see if, maybe this becomes an opportunity that will be useful or not. So HBK is offering a service like a legislative impact assessment. So this service includes an analysis of your business to look at, is there any opportunities with what you've got going on that you may be able to benefit from the new tax legislation. So this will be kind of a separate, paid service. We'll do an in-depth dive into your business and look at what you've got going on and what you might not have going on, but have the opportunity to, kind of maybe pivot into and make use of some of these provisions to, lower your tax bill or otherwise, produce better cash flow situation for your business. So if this is something that you're interested in, aside from general consulting that we might do for you, this is something that, we're really excited about, and we think it's going to provide a lot of value for our clients. So if this is something you'd like to talk to us about, please reach out. Excuse me. I think that's all the voice I have in me today. Chris, you got any other thoughts? We got any questions?
Thank you very much, Jesse. I don't know, Wayne, were there any questions from the attendees at this point?
Not at this point, no, gentlemen. Although if anyone would like to see, please feel free at this point to do so.
And as Jesse mentioned, there's a lot to unpack here, probably some opportunities that are unique to a lot of different businesses. So if you haven't kind of considered what this means for your business going forward and how it might impact you and what opportunities we have, just reach out and schedule an appointment. We'd love to kind of talk to you about how to maximize the benefit from the opportunities that this bill can create.
All right. That's everything. Then thank you, gentlemen, and thank you to everyone who attended today's event. There is no need to log out. Just close your browser window when this call completes. And please be on the lookout for our follow-up email containing a recording of today's event. More information and more webinars to come, so follow our LinkedIn for details, and be sure to turn on notifications. Have a great day, everyone.
Thank you.